My name is Shamika Byfield and I am the Managing Director for Shy Figures Limited. Today we'll be hosting the session called Getting Mortgage Ready, along with my co-host Daniel Bryan, who will join us later in the workshop. Today's session is mainly about getting yourself ready for that mortgage that you've been thinking about, telling yourself that you want to get to, but you really just don't know how. So we're going to go through a few things and then we're going to get to the question and answers at the end. Please do, as the questions come into your head, put it into the chat, because then Andrew will read these out and then we will be able to answer them as best we can. And don't be shy. I'm going to play my little arrow again. Yes, that's today. All right, so the agenda for today, I'll go through the different types of mortgages that are on the market that's available to you. The reason I'll do this is just to get some jargon busters out. So there are terminologies that they use in the industry that you probably don't understand. Do take note again, if there's something that you don't understand or you're not familiar with, put it in the chat and we'll explain it more. And then going on to the topics of getting yourself mortgage ready, just a few bullet points. Again, it's just to get you thinking and initiate conversation. You can always ask questions because I won't be going into detail. I want it to be as interactive as possible. And then we'll get to the question and answers with Daniel. Daniel is the Managing Director for Desk Mortgages. He's an independent mortgage broker and protection specialist, and he knows his stuff. So feel free to throw all the questions that you've always had or your friends have asked you or spoken about to us, and we'll help. So types of mortgages. You've got the fixed rate mortgages. You guys probably hear these adverts all the time. These mortgages, they stay the same over time. So when you do take a mortgage out, you take a fixed rate for a 2-year period, you know that that rate stays the same. Your monthly payments stay the same throughout those 2 years. And then you will need to renew, or it automatically goes to a standard rate. So fixed rates at the moment, I've checked them today, you have fixed rate at 1.13% for 2 years, or five years at 2.14. Whatever happens in the market, that rate does not change. That allows you to budget going forward, knowing that my mortgage payments will be £800 for the next 2 years, and I know what I'm doing in terms of my finances. It gives you peace of mind and it helps with that budgeting aspect. But with a fixed rate, it's always slightly higher than a standard rate because the market fluctuates. So it's never going to be as low as the standard rate. It's always going to be just a little bit more. And then you've got to think about, if the interest rate in the base rate of England interest rate falls, your mortgage payment is not affected. You don't get to pay less. You will stay on the rate that you're on. If it goes up, that's great. You're not affected either. So that's the pros and cons of having a fixed rate. But for me, the peace of mind sits really well. On a side note, if you do want to leave a fixed rate early, just like with anything else, you would be liable to pay a fee to leave, an exit fee. And also, once you're on a fixed rate, you need to start putting in that work at least 3 to 6 months before the fixed rate ends, so that you can start looking at the market, speaking to a broker or your bank to see what other offers are out there. Just like with your car insurance, you need to shop around. Anything that you see in red, those are little buzzwords. So if you don't understand what it is, make note and then just ask about it. Or there are words that you should be looking for when you are thinking about or looking into a mortgage in the future, the near future, or even long term. The second type of mortgage is a variable rate mortgage. This is where your mortgage payments, they vary and they change over time, and they can change at any time. So with the standard variable rate, which you'll see on most materials that's out there, is the SVR. And this is the rate the lender charges. This can actually last for the entire term of the mortgage, or until you then go into a fixed rate or any other type of mortgage deal. The advantages of having a variable rate is that you're not tied in. You can change lenders at any time. You can change the rate that you're on. You can go onto a fixed rate. You have flexibility, but you never know when they will increase that variable rate. So if you like peace of mind, you like to budget, you like to know what you're doing going forward, a standard variable rate might not be the best option for you. there are others. If you look at the second aspect, it's the discount rate mortgages. This is where lenders offer a discount on your variable rate. So for instance, you will see the SVR for a mortgage from X lender is 6% with a discount of 2%. So then you will then be paying 4% for a period of time. Compared to another lender saying, we're offering you 6% with a discount of 2.5%, you compare the two and see which discount is best. Or they might say 4% at 2.5% discount. So with the discount rate, the actual SVR might be high, but the discount might be better than if the SVR is low and the discount is lower. There are loads of examples that you could use, but understanding how these mortgages might benefit you in the short term or the long term is important, which is why, again, I'd say speak to a specialist when you're doing it, not just one specialist, but do shop around. With a discount rate mortgage, it starts off cheaper. And if the lower lenders, their SVR, your payments will reduce. So if they lower the standard rate, your payments will go down. If they increase it, your payments will go up. With these types of mortgages, you've got to make sure that you have savings set aside. So you go on a standard rate and you're happy paying £600 a month because the rate is really low at the moment because of the market conditions. Then in 2 years' time, the rate increases, or even 6 months, you need to be able to cover your mortgage payment. Your house might be at risk. So make sure you always have a little contingency fund, just sitting aside. Don't just spend all the money because the mortgage is paid for and you go shopping. This one is kind of my favorite, the tracker rate mortgages. These mortgages tracks the base rate of England. Yeah. What's the base rate at the moment? It's at an all-time low. It's 0.1% compared to a few years ago where the base rate was 2%. So this one tracks that. And if the base rate gets really low, your mortgage payments, they go low as well. But if the base rate does go up, your mortgage payments go up. So when you go in to discuss a mortgage, it's how risky you want to be, how it fits in with your lifestyle. I remember back in 2009 when the mortgage crisis hit, and everyone that were on a tracker mortgage, they benefited a lot. And even now as well, where the base rate is really low. So they would have had a tracker rate mortgage and it's tracking the base rate. So they would have 2% plus the base rate. And if the base rate is 5, it means that their mortgage will be 2.5%, 0.5. Then when the base rate drops to 0.1, their mortgage payments go down to 2.1. So it actually benefited them being on the base rate. But then you've got to think about what if something happens in the economy and the mortgage rate, the base rate goes up, what's going to happen to your mortgage payments? So that's with the tracker rate mortgages. Interest-only mortgages, yes. The interest rate mortgages is where you're only paying the interest on the mortgage. So the original amount you borrowed does not get paid every month. You're not paying any capital repayments on your mortgage. You're just paying off the interest. You could pay off the interest for the whole 25 years. And then at 25, the 25th year, you have £350,000 owed to the bank and they want the house or they want their £250,000. Daniel will go into more details about the interest-only mortgage. If you want to ask a question, please do put it in the chat at this point. Offset mortgages, that's the last one. This one, it links to your savings account and it links your savings account to your mortgages so that you only pay interest on the difference. So if you have 100,000 sitting in your savings, the lender looks at that as if it's 100,000 that you could pay onto the mortgage, so you wouldn't pay the interest on 100,000 off your mortgage, but you still owe the money. So it's a good way if you're really good at savings to have it linked to your savings account where they can actually see that you have money set aside. For me, tips when you are starting to look for a mortgage is to shop around and compare the deals that are available and speak to a specialist, not your friends and family that think they know, because what happens is the industry changes, the market changes, the conditions change, everything changes at the snap of a finger. So what used to be great 5 years ago could be really bad now. And I'd say if you're then look at the fees for taking out the mortgage, which your broker will help you with. What's the cost of actually getting a mortgage with that lender? and any penalties. So you're choosing a fixed rate, but what may happen in your life? If you're looking forward, looking ahead, what might happen in your life that would mean that you would need to change from a fixed rate and perhaps go on a variable rate to save £300 a month? So you got to really think about your own personal circumstances when you are looking to get onto the mortgage ladder. Questions, don't forget, because I am going really quick because I know that the question and answer session will be intense. Now, getting mortgage ready. How do you improve your odds of getting a mortgage? For me, the top one is fitting the lending criteria. Now you're going to ask, what's the lending criteria? That's why I put it in red, put it in the chat. The lending criteria is what these lenders are looking for, and they all differ. Like, you have lenders who they want to give mortgages to first-time buyers, or they specialize in self-employed. Thinking about your own personal circumstance, you need to be able to fit the lender's criteria. They probably only want someone with 999 credit. Doesn't make sense going and getting trapped in a rejection spiral when you don't meet the lending criteria. If you know that you want to get a mortgage of a certain amount, make sure you check out the lending criteria of those lenders so that you can fit. You're fit for purpose, basically. They look at your applications, they look at your past accounts you've had with them, especially if you bank with Halifax and you want a mortgage from Halifax, but your account's been overdrawn for the last 10 years. That's not good. So you need to be looking at other lenders, perhaps. Yeah, looking at your credit file, check your credit report. The credit reports are free at the moment because of GDPR. There are great ones and there are ones that give you some information. So finding the best one, again, Daniel's got that all on lock. So he will tell you which ones are good because he does this every single day. If you do have an error on your credit report, I would say get it sorted as soon as possible. Apply for a notice of correction, or you can even go to court and do an application notice to get it rectified, taken off, or set aside if there's a CCJ that doesn't belong to you. Register to vote. A lot of us are not even on the electoral roll. It's a big thing. Like, this will actually, you will fail. You might have really good credit and you're not on the electoral roll, but if you're not on there, you will not get a mortgage. Right? And also for those of you who may have had joint accounts with other individuals during your life, get yourself delinked from these accounts because their credit will also affect your credit. And when you are going for a mortgage, it will flag up. And manage your available credit. So credit utilization, if you have £10,000 worth of credit available, you might have a catalogue, a credit card, a few other credit facilities, and you've maximized them, you need to get those below 50%. Creditors don't want to see that you've actually gone up to your limit because you just might go over your limit. So keep your credit utilization below 50%, pay them off, and make sure that they're available there to show that you have a good, stable credit report and you can demonstrate your ability to meet your obligations every month. That's good. Having credit is better than not having credit at all. So I've seen a lot of people go for mortgages, but they've never had a credit card, and they say, well, why am I not getting it? Yes, because the lender doesn't know that you will pay. You've got no track record of paying on time. So you need to be building that up, whether it's paying your phone bill or just getting a credit card to do the shopping and repaying the full amount every month. You've got to be spinning your credit so that it shows on your file. Closing old or inactive accounts. If you have loads of accounts that you are not using, or you're just taking out new credit cards because they've sent it through the post, don't do it. Too many credit is not good either. Too many accounts on your file, it just looks as if you're desperate and you're just overusing your credit utilization as well. Always pay your bills on time. I know you all do that, so that will not be a problem. And just before, if you're looking about a mortgage, everyone will tell you don't apply for credit 6 months before, or even a year, because it leaves a footprint. So just leave your credit file, and every time you do apply for credit for something new, it lowers your credit rating as well. It's just how the system works. So if you're going to go for a mortgage in the near future, stay away from applying for anything that will be shown on your credit report. Cutting back on your spending. We all know about expenses and cutting your cost. cut back on your spending so that you can save for that mortgage just before you get there. If you've got anything that's irrelevant, not important, unnecessary spends, cut it back before you get to that place where you're about to apply for the mortgage. And when you think about your deposit, yeah, we know that, you know, the market had 5% deposits, 10%. Try to do a little bit more than is required so that they can see that effort. The lenders like to see that sort of stuff. And then once you get yourself all ready, you've ticked all the boxes, your credit is great, you're on the electoral roll, you then speak to a broker and get a mortgage in principle before you start looking at these houses. Estate agents are not interested unless you have a mortgage in principle, because they just think that you're wasting their time. A mortgage in principle is literally just an agreement to say, based on the checks that they've done right now, they would offer you X. It isn't a guarantee, it's just in principle. You will still need to meet the lending criteria. And then the biggest part for me is also the affordability. So of course, we want to do all these things and we want to get a mortgage. And then we start looking at houses because our dream home is in Kent with the front garden, the back garden, the picket fence, and all the niceness, probably a pool in the back and a jacuzzi. And that's going to cost us 700,000, but we're earning £24,000 a year. How does that fit in? You must understand the affordability calculations. And this is where my expert Daniel comes into play, because he does all the affordability calculators with his clients, and he will be able to explain a lot more about how you meet the affordability calculations to get that mortgage in principle in the first place. So Daniel, can I tag team you in? We'll take you off mute. There he is, Daniel. I'm gonna mute myself. I'm tag teaming you. I can't hear you. Andrew, is he on mute? Yeah, we can't hear him.
You can hear me now.
Yeah.
Good evening, everyone.
Hey.
That's right. Yeah, just going back on to this part that you're talking on. Yeah, all lenders have different criteria with affordability. And you need to make sure you're ready. 3 months bank statements, 3 months pay slips. They look at of your gross income. They can take bonuses, commissions, child tax credits, benefits. They can consider all these things. You know, obviously there's working parents. So, you know, there's a lot of other forms of incomes that can be used for your affordability. Jobs, you know, they can, if you add a new job, you know, you don't necessarily need to wait the 3 months, as long as you've got a track record of employment history. You can be, you know, they're more comfortable with that. So yeah, there's loads of everyone's scenario and circumstances is different. So it's not one shoe fits all. But again, speak to someone like myself just to kind of know, you know, I can just give you guidance of where you're at now. So at least moving forward, you know what to do to prepare yourself for these things, because you can get yourself credit ready, you're ready, but then all of a sudden your income doesn't fit and you're having to put down more deposit on your dream home. So yeah, it's it's a big problem of mortgage affordability that I find with clients.
Yeah.
Okay.
Right. Andrew, can we tag team you? Do we have any questions in the group?
Okay. Hi. Okay, you're going to take off the screen share?
Yes.
And I will make you spotlight.
Mika, do you want me to answer some of the questions that have come up in the chat?
So what we do, I just normally kind of go through it. So
Okay.
and then some of them will be for you and Daniel, and some will be for Shamika. So let's go through it. The first one is, hi Shamika. For SVR, which is standard variable rate, when and if your monthly payments drop, will you pay less over the full mortgage period, or will your mortgage period extend so you're still paying the same amount?
All right. So Daniel,
Over to me.
Over to you, yeah.
So yeah, the standard variable rate is the lender's individual rate. They vary from lender to lender. If you go onto a standard variable rate, then you pay your mortgage payments over the same term. So if you originally took out a 25-year mortgage, then you'll continue to pay your mortgage over. Wouldn't increase. The only thing that's going to increase is the amount of your mortgage going on to that higher rate. So yeah, you'll stay paying the same amount, but again, if the lender changes their standard variable, then your monthly payments can change. So it's just a guide rate. It's not a guaranteed rate. But yeah, your mortgage term won't be extended. On that, it will stay over the original term that you took out initially.
Thank you. Okay, what about stamp duty? Do you need to save the upfront with deposit 2, or can that be added onto the mortgage? So what about stamp duty? Do you need to save that upfront with deposit 2, or can that be added to your mortgage?
The stamp duty, unfortunately, is Her Majesty's taxes, and yeah, that's something you can't defer. It will form part of your deposit, and on completion, the solicitors will ask for your deposit and stamp duty to be transferred across to them. If you're a first-time buyer with no properties in the background, there's no stamp duty up to 300,000. So it's a first-time buyer incentive. Anything over that goes in a tiered scale, starting from 5%.
Excellent, thank you. Here's another one, Daniel. Can you advise on the journey for right to buy, and also taking out equity from the right to buy property?
First journey is applying to the council, which can be a bit of a tedious exercise due to the length of time they take. You put in the application, they will then come out and survey the property, and from then they will then send you out the valuation of the property and the discount that you get. The discount's normally 103,900, but I've noticed some people have been 110,000 because there may have been a tenant for like 15 or 20 years. So they can vary between borough. During that process, or even before, again, come to someone like myself just to say, Daniel, look, I want to get my right to buy. How much can I borrow? And can just do a quick affordability calculator. So at least then, you know, once your property is valued, and then yeah, feasible or not for you to purchase. If you are in a position to purchase it, and you go through the whole process of the mortgage, everything goes through, the council puts a charge on the property, which is called a pre-exemption charge. It stays on there for 5 years, which means if you sell the property within that period, they can recoup some of the discount that they've given you, which means it's difficult for you to remortgage and take out any of that gifted equity within that period of time.
Excellent, excellent. Okay, everyone, please put your questions in the chat. I've got a question as well, Daniel. Okay, so I'm on an interest-only mortgage, and I've had it for about 15, 16 years now, so I've kind of done really well. But I wouldn't recommend it for my daughter, and I maybe wouldn't recommend it for many people here as well. But why wouldn't I recommend? What's your thoughts about the interest-only mortgages as well?
Obviously, interest-only mortgages were common for a lot of people to get on the property ladder and have low mortgage payments. The downside of that is a lot of people over the age of 55 have asked mortgage business because they're coming up for expiry, and they may have a high balance, and their income and their age and all these factors coming into play, they can't afford to switch it onto a repayment mortgage. So they're looking at the moment to doing things like downsizing, and moving locations. So interest-only mortgages for the clients that I get, I normally only do them for clients now that are high-income earners, or they've got other assets that they know that at some point through their mortgage they'll be able to clear off the interest, but they just want to keep their payments low from the time being. So now, yeah, I do them. They do work, but they only work really for if you've got assets or lump sums or higher income in the background that you'd definitely be able to clear the capital element of it.
Yep, thank you. That's exactly what I'm planning to do as well. So there we go. Okay, we've got a couple more questions that's just come through. Can a person go for second mortgage with partner if one has previously mortgaged before?
Yes, that's not a problem. If there's still a property in the background with that partner that they may be letting out, that's not a problem. The only additional cost that you will have is that you won't get the first-time buyer's incentive if you go on the mortgage together, because obviously that person's had the mortgage before. There are some lenders that do niche things to get around that, but that's only a handful of them that you can do that with. But majority of lenders are happy to consider all clients, whether they've got one property in the background, 10 properties in the background. It's not an issue, so it wouldn't impact. It'd only impact if that other property is another residential, and person wasn't going to be living with you, because then it would affect their affordability on a monthly basis. Excellent.
How can people find you as well, Daniel?
I've got a website, www.desmortgages.com.
Okay, put it into the chat as well.
I will do. And I've got an Instagram which I've just started. Yeah, that will start to be alive and kicking at some point.
All right, put that into the group as well. Okay, we've got another question. How do lenders stand on women who are, maybe that should be, why do lenders stand on women who are trying to get a mortgage with small children?
No discrimination. Again, it's based on affordability. Unfortunately, sometimes, depending on your income, a child can lose us about 15 grand in affordability with what we're trying to borrow. But again, if you get tax credits, child benefit, any other form of benefits or support, maintenance payments, you may not be with the child's father, then these can all be used to contribute towards your income. So no, the lenders are quite supportive with single mothers.
I think this lady might not agree, but let's see if she comes back with any other questions.
Okay.
Who is the first time buyer? Who is the first time buyer? Is it the person who hasn't got any property in the UK or overseas?
Would it change things?
Yeah, it's just based on UK. Just based on UK. So if
Sorry about that.
no problem. Yeah, it's just based in the UK. Anything you've got overseas wouldn't go against you here. So yeah, it's just here.
Excellent. Okay, everyone, please continue to put your questions in the chat. If you're here, you must have questions for the chat. We've got Daniel with us for at least the next 20 minutes as well. So Shamika, is there anything else you wanted to add as well? One more question.
Wait, I've got one question.
Go for it. Okay, 1 second. Let me spotlight you.
Daniel, how has COVID affected the lending criteria, and what knock-on effects will that have on first-time buyers?
Yeah, COVID's had quite a dramatic effect on the mortgage market. Some lenders have pulled from the market just based on just based on how they're set up and their backers and funders. So it's not sustainable for them to continue. Obviously, the government has allowed people to have payment holidays and mortgage holidays. So that, again, that's had significant impact on the lenders and their vision moving forward. So they all started to change their loan to values and reduce them. So immediately when the lockdown happened, everyone went down to 6% loan to value or withdrew from the market. And then gradually, as things started to be relaxed, they've steadily come back up into the market. So they're all at 85% maximum now. Obviously, other lenders have still got different loan to values in between, but the majority of them are back up to 85%. But again, criteria has changed. Some of them have changed their credit scoring policy, have made it a bit tighter to get mortgages with them. People have been furloughed, so they ask the furlough question now: are you being furloughed? So again, they won't take people that have been furloughed, so they want to wait for them to go to work. So it's busy, but it's affected a lot of people because a lot of people want to get 95% mortgages, 90% mortgages, and that market's been lost at the moment now, unfortunately.
Did the payment holidays? I know a lot of people say, "Oh, cool, I'm gonna apply and try and get 3 months payment holiday or so." But would that affect your credit check as well, or did that affect people as well?
No, it doesn't affect your credit check, but what it affects is possibly you remortgaging to another lender. And I've had a couple of clients that forgot to tell me that they've done payment holidays. And the lenders declined their application. So it's again, some people have taken payment holidays and then they're remortgaging to take out equity and capital raise. But obviously, the reason why you've taken the payment holiday is because you can't afford your payments at the time. That should be the genuine reason. So based on that, obviously lenders are saying, well, you can't afford to make your payments at the moment. How are you going to afford to have increased payments by taking out more money? So, obviously I'm trying to advise my clients, only take it if you're in a financial position, you take it, just don't jump on the bandwagon and just take it, because the payments get added to, so what some lenders are doing, they either increase your payments once it's finished or they're adding it to the end of your term.
Yeah.
So that's between it, but again,
okay.
Only take it if you need it.
Okay, you've got quite a few more questions coming through now as well. 10-year fixed rate, want to extended lease, may need to raise additional funds. Is it too late to add to my mortgage? Am I likely to incur a penalty? Did you get that message? Did you get the 10-year fixed rate?
Yeah, what the lender may be able to do, depending on, I see it here from Eddie. Yeah, depending on the lender that you're with, you should be able to do something which is called a further advance or a second charge. So further advance is where you go to your existing lender to get additional funds, which can support you for this lease extension transaction. If they don't do it, what they may allow is you to go to a second charge company to get out a second charge loan to again support you with that transaction. So hopefully either way, you should be able to do either to do lease extension.
Excellent, thank you. How far back do they search for your credit? How far back?
6 years.
6 years, wow.
It's a 6 year footprint on your credit file. So that's how far it goes back. Depending on what's on your credit file, like CCJs, IVAs, bankruptcies, things like that. They can have quite a, if it was 5 years ago, it still can have a lasting impact on your credit file.
Excellent. Okay, you've got about 10 more questions, so bear with us. As a first-time buyer, I'm a first-time buyer, but my partner is not, and we want to buy one together. How does it work?
It's straightforward.
Forward.
You can still apply, as I said before. I think someone mentioned that before. You just may have to pay the stamp duty. You just may not get the first-time buyer's incentive on the stamp duty. So that would be the only difference with having one. There are some lenders that which is called joint or a sole proprietor. So you both could go on the mortgage together, but the first-time buyer would only go on the mortgage deeds, which means land registry will then count you as a first-time buyer. So there are tricks, but again, some people may not be comfortable with that, and you both want to be on the mortgage deeds. But yeah, there's ways to get around it.
Okay, there's one more. Can you please explain the pros and cons for buying as a single person and as a couple?
Oh, do you want to be financially committed to that person? I think that's the main pros and cons. No, I don't. I think obviously if you've got two forms of income, it allows you to achieve a bigger goal rather than doing something under your sole income. So I wouldn't really say there's pros and cons to it. It's just kind of what's.
I'm assuming you can get a larger offer, a larger mortgage.
Yeah, definitely with two forms of income. So again, it's just going to be what's both of yours. Are you doing it to live together? Are you doing it for other intentions? So again, it's just going to be your intentions. But yeah, more money combined obviously means that you can get something a lot better and bigger.
Have you had any horror stories about that? You don't. Please don't say.
Yeah, there's a lot. There's a lot of clients that I've done their mortgages as a couple and they've split up.
Yeah.
So I've got a lot of that going on now.
Okay. Well, this has been recorded for YouTube, so don't say no names.
Yeah.
Okay. Here's a few more. Sorry, you've got another 9 waiting. So here we go. If you live in a council property and are eligible for discount and right to buy, will the stamp duty be added to the discounted value or the house value before discount? Jeez.
So basically, on your right to buy, you'll be a first. I'm going to assume you've never bought a property before, so you'll be a first-time buyer. So anything under £300,000, there is no stamp duty charge. £300,001, then it starts at 5% of that.
I'm going right, yeah.
Hey.
Thank you. Take it easy, yeah.
Sorry about that, everyone.
Sorry.
Okay, next question. Okay, can you take out equity from your parent? Wow, can you take out equity from your parents' house that has been paid off, and then take the equity to remortgage the same property?
Ooh.
And can the house deed be transferred to the child? Jeez.
Yes.
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 Okay. Oh, that's a nice simple one. There you go, sir.
Yes. Yeah.
Okay. Also, is another one. Also, can you please cover what the standard earnings and savings you should have before considering a mortgage, of course?
Standard earnings, it depends where you live. Obviously, if you live up north, and the houses are £100,000, then if you're on 20 grand income, then it's sufficient enough for you to buy a property of that size. So earnings is just going to really depend on location. Savings, aim for 15 to 20% at the moment of what you're looking to buy, and obviously solicitors' costs be about 1,500. So yeah, obviously you need furniture and things like that. So probably an additional 3 to 5 grand on top of your 15 to 20% should be sufficient enough.
Okay, thank you. Next one. Also, can you? Yeah, is money box a good way to save for your deposit, or can you recommend any other way to save for your first-time buyers? Shamika, you talked about this last week as well.
Yeah.
Yeah, it is. It is if it helps. Obviously, the government had help to buy ISAs and things like that before, so they're kind of phasing. I think this money box one's phasing out soon as well. So yeah, again, it's anything which gives you, in a sense, the money box one. If you put money into it, they give you money back as well. So yeah, it's at the moment, yeah, that is quite a good one out there.
Okay. At this point, let me just ask everyone who's just joined, if you do want the fact sheet and to also complete the survey, please put your email address in the chat so that we can, so that I can send you the information. So please put your email address if you have not done so already. Daniel, here's another one for you, sir. Is it wise for parents to remortgage to get their children on the property ladder?
Depends how nice your parents are. Yeah, I've had clients that have remortgaged, that I've remortgaged their property to give their child or children money to purchase a property. So yeah, it's again, it's dependent on your family dynamics. But again, financially, if it's comfortable for everyone, then yeah, it's not. I wouldn't say it's not a wise thing. It's just, is your parent doing it to not get the money back, or do you have to give them the money back down the line at some point? So, but yes, it's a nice supportive way. A lot of communities do this with their children. So no, it's a good thing to do.
I'm doing that with my daughter, but the only stipulation I've said is if you sell the house and there's profit, I want the money back.
Which again, that's the terms and conditions.
That's the terms and conditions.
Yeah,
I'm saying
enough.
yes, it's good. Yes, we have to help them to get onto the mortgage. But yeah, if you do sell the property in 10 years' time and you got 200 grand, and then pay it back.
Yeah.
Next question. Why do you have to be on the electrical roll to get a mortgage? Also, is it wise to get a mortgage now? Jeez.
The electoral roll, the lenders like to know where you are. So the more transparent you are, the easier it is for them to be secure about you. Also, being an electoral roll gives you about 88 points, nearly 100 points on your credit scoring. So for something so simple, it does have quite a significant impact on your credit file. But again, yeah, if you've been living at an address for 10 years and you're not an electoral roll, the lender's gonna think that doesn't really make much sense. So they may look a bit more into it. Is it wise getting a mortgage now? If you've got the deposit, if you're able to put down 15 to 20% deposits, yeah, because the rates are really, really low at the moment. So it is a good time to buy in terms of taking advantage of the rates. Obviously COVID's going on. We don't really know what's going to happen, if the market's going to fall come October, November. But again, based on interest rates right now, yeah, it's definitely a good time to buy.
Excellent. Okay, we've got 17 more questions, Daniel, so please bear with us. You mean this group started slow? They started slow, but they have really kicking it in now, and we haven't lost a single person as well. We're up to 33 people, and normally with question and answers it goes down, but everybody stayed on. So
must like me then. That's good.
So we've got you for another 15 minutes. Okay, here we go. How does house sharing work, and where you buy? Oh, sorry. How does house sharing work where you buy part of a house?
Okay, so that would be called shared ownership. So where you kind of part buy part rent. I'm assuming that's what the question's asking. So yeah, if you just go onto the website and just type in shared ownership, it'll come up with lots of housing associations, because they're normally the ones that will do the part by part rent on there. They will have a calculator on there as well, so you can put all your information in just to see if you meet their criteria. And again, then it's just straightforward. You just get a mortgage on the share that you're buying. It normally starts from about 25% of the property value. And you normally would have to put down 5 to 10% deposit of the share you're buying. So if you're buying your shares 100,000, then you don't have to put down £5,000 to £10,000 deposit. So again, for people whose incomes are slightly lower and they want to be in a specific area, it's a good platform to
I must admit, Daniel, I actually don't like that. You mean when they first came out, I don't know, 10 years ago. You know, I thought it was crazy how you can.
Yeah, I don't really do a lot of mortgages for them. They're quite few and far between now.
Yeah. Okay, if you have no debt and nothing on credit, how much do you recommend you should use and pay back on a credit card each month for a healthy credit rate? If you just spent £100 a month on credit and repaid in total each month, is that sufficient? Wow, that's a good question.
Yeah, as long as you don't exceed, it's about just your usage. So as long as you're staying under 50% of your credit limit, then use it as you will and wish. Obviously, if you've got a balance on there by the time you come to get a mortgage, and you're not in a position to clear it, then it goes against your affordability. But again, if you do something like that, obviously you're building up a credit history that you're able to repay your credit card back on a monthly basis. But yeah, just stay below 50% if you do that.
Excellent, thank you. Will the interest rate likely be the same as my 10-year mortgage? Will the interest rate? I think that might have gone up to a further question earlier on. But that's half a question, so it's a bit hard to answer that one.
Yeah.
Do you personally think that property prices will go down in the nearest time?
Could do. It's a bit. I thought property prices would have gone down post-COVID with what's happened in lockdown, but valuations so far have only been between 1 to 3% getting down valued on physical valuations at the moment from the cases I've been doing. So that's really good based on the climate at the moment. But yeah, obviously the government are still supporting a lot of businesses at the moment. So yeah, the full effect of what's going on is not yet to be known. So possibly, but again, if it's your long-term home, properties will, can go down, but they will come back up again at some point when the economy recovers. So again, it depends on your intent on buying now.
Excellent, thank you, Daniel. Daniel, just tell us where people can find you again. Sorry. Do you have a physical shop, or do you guys?
I'm based in Croydon at the moment, my office, but I'm relocating to Beckenham. So I do have a physical office, not a shop front, but I do have an office. So obviously now I'm doing Zoom meetings. Obviously everyone's isolating and social distancing. But yeah, I'm contactable on email. I've got a website. But again, I'll put all that information in here so people can contact me.
Okay, a few more questions. What time is it now? Okay, in 3 minutes time, no more questions, guys. I would say, when we stop it where we are. Is age a determining factor in the eligibility for a mortgage? If so, what is the cutoff age? Would it be?
So I done a mortgage for an 83-year-old woman last year. So
wow.
Yeah. So no, there's no real cut-off age. Again, there's all different criteria and scenarios for people. The majority of lenders stop at age 70 because they deem that as new age of retirement. So majority of lenders only go up to age 70 for a mortgage, but there are others that will go past that, depending on, are you paying into a pension, a private pension? You know, is the job that you're doing, can you, you know, if you're a builder, then that won't go past 70, but if you're a tailor or you work in an office, or, you know, solicitor, an accountant, they're kind of job that can go past the age of 70. So yeah, there's no limit in that sense.
Okay. So are you saying if a person is not on the electrical register, they can't get a mortgage?
No. What I'm saying is that it lowers your credit scoring, so it would likely reduce the type of lender that you can get a mortgage with. So majority of high street lenders have a minimum credit scoring that they require to get passed through them. And if you're not in the electoral role, then yeah, it may just affect your credit scoring to go with them. So yeah, you can still get a mortgage. Be asked why you're not in the electoral role, but it will just, type of lender you get just may be affected by it. That's all.
Excellent. Why is shared ownership not a good idea? I don't know if that's aimed at you or me.
I think shared ownership is a fantastic idea if that's your budget at the time. You know, shared ownership allows you to staircase, so at some point you can own 100% of the property as you build your income or your jobs or your career aspirations and things change. So yeah, it's not for all, but it works. I've had some clients that have been able to buy 100% of their shared ownership, where they started off at 25, 50%. So, but again, they had joint income, so they were able to do that.
And I think just for myself, I think Daniel just touched it, is that you normally start on a very lower rate. So it might be 25 or 50%, but you're paying kind of like 2 mortgages, and, you know, you're paying, you know, for that 50%, then you also have to pay for your rent as well. And sometimes it's very, very high. So I found that a bit, me personally, I found that a bit kind of crazy to do that. But Daniel said that other people have done it. So it's good. What I would like to see, Daniel, is it'd be interesting to see how many people, if we've done a study of how many people done shared ownership and how many people have actually gone up and bought more equity over the last 10 years. That's something I would like to see.
Yeah, I think it's minimal just due to inflation in property prices.
Yeah.
It's just not been, you know, I've got a client that's got one in Clapham, worth, I don't know, it's been valued at 650 grand.
Yeah.
And she's like, I can't buy it, I can't do it anymore now. So she's looking to sell it because she's just kind of been priced out of the area. So yeah, so
yeah,
they put them in areas that are growing. So yeah, majority of those areas, yeah, it's not affordable.
Okay, I'm going to ask for no more questions to come through, please. I see 26. So, Daniel, I'm going to ask for 1 minute answers on all of these.
Yeah, no problem. Quick fire round. Let's go.
Quick turnaround. On the back of my earlier question, because of COVID, are we able to get a mortgage right now or not?
Yes.
Yes.
Open for business. Let's go.
Excellent. I am £3,000 in debt, and credit score is obviously below. If I pay off my debt, sorry.
Okay, I'll read the question.
Can you see that one? Sorry, I scrolled down.
So basically, once you clear your credit cards, it will take a month to 2 months for your credit report to update. So obviously, once it updates, then yeah, you'll see your new credit scoring, so you'll be in a position to purchase from there.
Excellent. Insightful response regarding property valuations. Thank you, Daniel. Is there a charge for you to value the worth of a property? I'm assuming that's directly at you, Daniel.
No, I don't.
You're not a surveyor.
I'm not a RIC surveyor, unfortunately. I stay in my lane. But obviously, when you get a mortgage, some of the lenders give free valuations, so they will send a surveyor out to check the property on your behalf. If you buy something that's a bit more of a fixer-upper, then you'll need to get independent RICs surveyor to check the property out for you by doing a home buyer's report or a full building survey.
Okay, just the last couple of questions now. I am fortunate enough to get nearly 25% gift from my dad towards my mortgage as a first-time buyer. Oh, that's nice. Could I get a mortgage in principle without having it as yet, as he's waiting to sell his property to give me this?
That's fine. If he does got another 25% for me, that would be nice. Yeah, but yeah, no, definitely you can get a decision in principle. Some lenders, the decision in principles last between 30 and 90 days, depending on the lender. Some are a soft credit search, so it doesn't have an impact on your credit. So it won't leave a hard footprint or lower your credit scoring. It stay on there for 30 days. So yes, you can get a mortgage.
Excellent. Last question now as well, Daniel. Will the interest rate likely be the same as my 10-year mortgage? Refers to the previous question, 10-year fixed rate. Want to extend lease, may need to raise additional funds. Is it too late to add to my mortgage? Am I likely to incur a penalty? Loads of different questions in there.
No. If you go to your existing lender to get a further advance, again, I'll do further advance for clients. There's no penalty because you're not changing your current mortgage. So it will just go on as like a second loan on top of your current mortgage, or third parties offer second charge loans to do it. So you can get additional funds without incurring any penalties. The only time you'll pay a penalty is if you want to move a whole mortgage to a new lender.
Excellent. Daniel, wow, thank you so much. You went through all of those questions excellently. Are you ready, Shamika?
I am.
Excellent. Thank you, Daniel.
Welcome.
I've got 4 pages of notes now to add to the fact sheets based on the questions that were asked, because it would be good for those who didn't get it to just be able to see the answers. On a side note, I'd just like to just run back through just a few things quickly. I think the key message here is to always get in touch with a mortgage specialist and do an affordability calculator, because everything that we're thinking becomes obsolete if we are unable to get the mortgage because we feel the affordability aspect of it. So of course, speak to Daniel, speak to your bank, speak to whoever, and do your affordability calculator. It will also help you in terms of budgeting and forecasting for the income that you will want and the deposit that you'll be looking at. So Daniel did mention a lot of the LTVs, that's the loan to value. So lenders will then have an LTV of 80%, where they're only lending 80% of the mortgage, which means that you need 20%. Pre-COVID, there were 5% mortgages available to first-time buyers, which means that the LTV would have been 95%, and you would only need to find 5. As Daniel recommended, try to at least save up 15 to 20% of the property price for your deposit, and that does not include your solicitor's fees, and if you go over the 300,000, your stamp duty as well. So you need mortgage advisor fee, you've got that little percent, and you've got the solicitor's fee as well. So think about those in addition to the deposit that you want to put down on the house. Homeowners, yes, we talked about the money box last week. Anything that's given an incentive to help you to buy a home, if that is in your future plans, do take advantage of it. Help to Buy ISAs are gone, but Money Box are offering something similar, even if it's £50 that you did not have to work for. It's great. Electoral roll, yes, it's wise to be on the electoral roll, like Daniel said. If there's a reason you don't want to be on it, then that's up to you. But if you can get to 999 credit without being on the electoral roll, brilliant. We would recommend going on your electoral roll. Getting mortgages right now, yes. Interest rates are really low. Fixed rates, not so sure about. If you put it on a fixed rate and the market crashes and the interest rate goes down, then you might be upset. But if you have your deposit and you're ready to go, house prices, we don't know what's going to happen. So I would say, like Daniel said, do what you need to do now. Shared ownership, Andrew doesn't like it. Houses in Clapham, definitely a no-no, just because of they've outpriced everyone in the market, as Daniel said as well. we can't buy it in South London at the moment. So if you're going to do a shared ownership, look at the area and think about how much it will cost to actually get to 100%. And it's a good way to get on the property ladder as well. If you have a small income, if you're a single parent and you can only afford £100,000 worth of a mortgage, do look into shared ownership in the right area. What was my other note? Daniel. COVID, yes, you can still get a mortgage. And clearing your debt, that was a really good one. Once you clear your debt, just make sure there are no CCJs or defaults, because clearing your debt of £3,000, but you have 5 defaults on there, it's not going to be any good for anyone. That is it from me.
Okay.
From me, yeah. I will send us the fact sheet over with more details. I'll speak to Daniel as well and Andrew, see what else I missed. Yeah.
Well, thank you so much, Shamika, for joining us today, and thank you, Daniel, for an awesome time as well. Everyone, we will be here next week, Thursday, for part 3 of our finance session. But as well as that, we're also having a workshop on here, same on next week, Wednesday at 7 p.m, regarding CVs and how to get back into the employment field after COVID as well. So please join us here, 7 p.m. next week, Wednesday, regarding CVs and employment, and of course next week Thursday here again with Shamika. So thank you everyone.